Happy Wednesday. Welcome back to another week of the Educated Homebuyer Live with Josh and myself here, updating you on the economy, updating you on mortgage rates, updating you on everything when it comes to buying and selling a home to help you guys become educated homebuyers. Josh, kind of a blah week in the market, which I think is welcomed at this point.
Yeah, it is. And the funny thing is, it's not the perspective that we're getting from consumers. They're like, "Oh my God, what's going on? Why are rates going up?" We'll get into that in the details, and we'll talk about it. But the sky is not falling. This is perfectly normal after a giant drop over a 60 to 90-day period that we would see a little sideways, a little give back, a little consolidation.
And we're actually going to show that in some charts as we get started here today. But do us a favor, if you're listening right now, let us know where you're listening from. Let us know how the audio is coming out. We always just want, a quick check, make sure everything is good. Let us know where you're listening from. And more importantly, let us know what questions you have so that when we're done going over the charts this evening, we can dive right into your questions so we don't lose any time. You get the most bang for your buck. And, we all have a good time here. So, Josh, yeah,
Look,
go
Jeb,
ahead.
if they don't give us super chats, we don't get bucks. So they're getting all of the bangs for $0.
For $0. That works too. We're not here
That's
to
a
make
deal.
money per se, but we're here to provide value and hopefully help you guys, save some money on the other side. With that said, Josh, we are going to dive into charts. We always start with inventory because it tells the story. And this week we have inventory still climbing, 725,000 unsold single family homes on the market right now. That's up 37% more than last year. And that's 2 weeks in a row where we've had at least 10,000 units come to the market, which is kind of uncommon, especially for this time of year. But, with rates coming down, more sellers trying to take advantage, something to pay attention to. But I think we're getting close to the peak. Orange County active listings sitting at 3,638, pretty much the same point we were last week, 0.27% decline week over week. So a little 5-6 less listings than last week, whereas Huntington Beach is basically the same, 246. So no change week over week with regard to inventory. And what we're seeing is more homes come off the market. Sellers just getting to that point where home's not selling, they're pulling it off the market, and we've got inventory coming to the market that's sitting a little bit longer too. So that's where inventory is remaining stable, even with homes coming off. New listings, 70,000 new listings unsold this week, only 10,000 immediate sales. That's 10% more sellers than this point last year, with very few immediate sells. It looks like buyer urgency has finally been exhausted, according to Simonson from Altos Research. And then our week over week change, we went from 713, 660 to 725, 249. We're currently sitting at that peak of 725, 249. So, are we going to continue to climb week over week? As I said, we will see. But for context purposes, back in 2015, we were almost 1.198 million homes, so almost 1.2 million homes. Existing home months of supply. So this came from Calculated Risk, Josh. I found this an interesting chart because our supply is up, year over year. It's that red line there in the middle, but we're still trending, below 2018 levels, right in line with 2017 levels. So at the moment, we got homes coming to the market, but again, it's not a crazy time. We're not seeing what you'll see here when we look at price cuts. You're not seeing people just cut prices to try to get rid of stuff.
I can't see anything but that black line. That is so bonkers seeing it go, 45 degrees straight up there when you have the lockdowns, and then somewhat loosens up and just plummets.
It's, when you drop rates as fast as they did, people, it pulls demand forward, as we've talked many, many times. Another look at housing units. So this just shows U.S. housing market is 1.5 million housing units below a balanced market. And essentially what this shows is if you added 750,000 homes to the market, you still wouldn't have much of a change with regard to where supply is. versus I'm looking for my notes on this chart and I can't find it, but basically the way they phrased it was if you added about half of the number of homes that we need, you would still have a truly unbalanced market based off of what Freddie Mac thinks where they think we actually need to be.
I'm going to have to go back and read that article, Jeb. The part that boggles me about that is that as recently as 2012, this chart says it was essentially balanced. Like that seems like it was far longer ago, but possibly because we overbuilt so much, right? Into
Yeah, and then
2007,
in
2008.
2019, we were sitting about four months of supply, which is essentially where we are at the moment. 6 months. I don't remember the last time we had 6 months of actual supply of homes. It probably 2012, 2013, somewhere in that ballpark, right before the market changed. Pending new contracts pending. Home sales ticked up this week. 62,000 new contracts started on single family homes. Watching the newly pendings next week to see where sales are actually going. And then median price of new contracts ticked up, sitting at 389,900. And then the price cuts chart we didn't have again this week, but price reductions ticked down to 39.9%. It basically just shows that there isn't panic selling even as inventory builds. So it's the fact that it's coming the other way. We were just over 40%. Now we're just under 40%. Shows that, people aren't just, dropping price to get rid of homes.
Jeb,
Yep.
there's some important psychology there that the people need to be aware of. And we've probably touched on this before. People are very resistant to sell at a loss. So if you saw home prices start to come down, it's going to make people even more resistant to selling. And that's not just a loss, not meaning, hey, I bought for $100,000. If I sell for 99, it's a loss. I bought for 100,000. It went to 999. Selling for 998 is a loss to those people. And they've shown over time, homeowners are very resistant to loss. They will stay in their home for an extended period of time versus realizing that loss and moving on to another property. Obviously, all the things you talk about, death, divorce, job loss, can make that not a choice, but by choice, they will hunker down and stay there for a while.
No, assuming they can, right? So this is a survey that I believe Fannie Mae does annually, and what they do is they survey 100 economists to essentially ask them where they think the market is going over the next 5 years. And what we're seeing right now is these economists are predicting 4.73% for 2024. Just over 3% for 2025, again 3.29 for 2026, 3.75 for 2027, and 3.88% for 2028. Now, what does that actually mean for value of a home? So what they did here is they took a $450,000 home and showed you what that looks like over that 5-year period of time, which is essentially adding about $91,000 of equity gain during that period of time. So nobody likes equity gain except for those people that actually own homes. When you're the buyer sitting on the sidelines, it's, you don't want to see homes continue to appreciate like that. But that's part of one of the benefits of home ownership is that price appreciation.
Jeb, I want to piggyback on your chart here.
Go ahead.
So $450,000, you can acquire that property for 3% down. Call it 15 grand, 15 grand plus closing costs. And in 5 years, if these guys are correct, I mean, this is small relative to the last 5 years, but if those 5 years are correct, you'll have $90,000 for your $15,000 investment. So remember that. I've got a chart here that kind of pulls that back.
All right. And that's where we're going to go. So growth of $100 by asset class. So Josh, take us through this.
Everyone looks at this and says, real estate's not that great of an investment. If you had just invested in the S&P, you'd come out far ahead. So if I put $1 into real estate back in 1970, I got $1,500 today. Pretty good return, but I would have 22,419 if I had put it into the S&P. But here's the reality. I didn't buy $1 of real estate in 1970. I bought $30,000 of real estate in 1970. And I did that with $1,000 down payment with a 3.5% down FHA. Call it $2,000. So my $2,000 is now gone up 1,500 times. So that is where people get lost. We're not saying, hey, real estate is superior to the stock market, so only invest in real estate. We're saying you're going to fall behind and have trouble. If we look, the funny thing is, I pulled this is from Visual Capitalist, but the person who shared it with me, their conclusion was, hey, homeowners are falling behind people that own a bunch of assets. And I said, well, that's kind of dumb that you would say that because they're highly correlated. People who own homes also are more likely to own stocks, either directly or indirectly through their 401k. And they were saying, well, if you own a house instead of owning stocks, you're falling behind. And you're absolutely not, because you have 10 to 30 times leverage for most of my clients, putting anywhere from 3 to 10% down. And that leverage brings that return up very similarly. And we've shown the numbers before. If you look at household net worth, the majority of it is in home equity, or a plurality of it is in home equity in addition to stocks. And that's how they perform very similarly to people over time. It takes much longer to build up that big nest egg in stocks because you're not leveraging it like you do a real estate purchase. But thought that one was interesting there. This one, we're going to get Jeb next week, that we get JOLTS and then the September jobs report already. It will be here. This is going to be an important piece of data in there. You're starting to see U.S. employment part-time for economic reasons, meaning they could only find part-time work. Not, hey, I'm semi-retired, I only want to work part-time. I want to work 40 hours a week. I could only find a part-time job. And that is ticking up. And if you look, every time we see it tick up, it runs through one of those recession bars. So we're not out of the woods. It's not totally safe. We're not guaranteed a soft landing. So I thought that was important. Jeb, we ran through this a few weeks back. What happens during Fed cut cycles? Going back to the 80s, there's been 8 cutting cycles. Prior to the first cut, the 10-year treasury drops 140 basis points. From the first cut to the low point in the 10-year treasury, it drops another 150. So this is where I want to take the conversation back to what has happened since the Fed cut. So this was actually sharp. We peaked at 5.02. At the time we showed this was 366. So we were down 1.36, and the target, if history is a guide, would get us down to about 2.2%. So what has happened since that Fed cut at 50 basis points? We went sideways for 1, 2, 3, 4 days. And then it's kind of been a little bit of an uptrend there. So we're up 15 basis points. So what does that mean to you in the real world? Mortgage rates are up about 1/8%. And you're going to see they're up less than that over that week based off of spreads narrowing. So what we're seeing, we've talked about this, Jeb, leading into the Fed meeting. We said, hey, the Fed does not dictate long-term interest rates. They will impact the short end of the curve, 2-year treasuries, 3-year treasuries. That pink line is 2-year treasuries, and the blue line is 10-year treasuries. So you see the 10-year has gone up since the Fed cut, and the pink line, the 2-year, has continued to go down. So what you're seeing is we have uninverted. And there are some people who are economically uneducated who say, look, we're fine. We uninverted, crisis averted. But the reality is the recession rarely sets in before it uninverts. So the inversion is the signal. The uninversion is kind of about the time that it shows up. So not predicting it, just saying that we are not out of risk of a recession, which paradoxically would be much better for interest rates. So if you're not in the market, you're wanting to buy, you want better affordability, you're actually rooting for a recession as long as you're not one of the people that loses your job. So that there was 15 basis points for up. But what I wanted to show, Jeb, this is 3 selected. There's actually been 4 times going back to the 80s that the Fed has had a 50 basis point cut. And this is in 2007. And what happened? They cut, and the 10-year went up 30 basis points over the next couple, 2-3 weeks before starting the long drop down, where it dropped 139 basis points to the bottom, almost right in line with that 150 projected by the average over the last 40 years. 2001, same thing, 50 basis point emergency cut. We go from 4.9 to 5.30, so up 40 basis points. And you get a quick initial drop over the next month or two down to 4.75, and then another little run up, but the big long run, 134 basis points down, and that was 2001. And then we have 1991. If you could see a little bit bigger, the numbers along the right side, these are crazy because these are like 8% treasuries. All of you youngsters have no idea what those look like, and the oldsters in the audience who were around in the 70s and 80s go, that's nothing. I've seen 12, 15%. But we had another 50 basis point cut. Market reacted nicely in the short run before running back up about 40 basis points, traded sideways for about 3 months. And then we see this 160 basis point drop. So it kind of leads us back, Jeb, to that conversation we've been having with so many people. Like, why would I refinance now? You guys keep telling me that rates are going down. Most likely to, not guaranteed to. And it doesn't just always happen right after a Fed cut. So I wanted to give you guys some context here. This is that same chart of our downtrend over the last 6 or 8 months. And it shows we've run up. We're still in that blue downtrend channel, but we could easily trade sideways before getting the drop. And that is where we would end up if we hit that 2.2 target that would be projected by the historical average after a first big Fed cut. So we might line up anywhere along that green line. We might never get that dip. I would be shocked if we don't see more of a dip here in 2025 into 2026, but where we end up on that line is the mystery. This one, Jeb, you know I like to run the spreads with the optimal blue index data that is also in Fred now. So this is a little bit more real time than most of the spread data that you see. And we had got all the way down to like 2.3 earlier in the week. I think it was 2.31. It's up to about 2.37. But visually, you can see there that is the lowest it's got in quite some time. And what that's telling you is that lenders are getting more comfortable that with rates at these levels, those loans will stay on the books longer, and they are competing for business to get servicing rights and loans on the books. So as long as we keep seeing that, we're going to continue to see improvement. That's telling us why mortgages are not up quite as much as that 10-year treasury that we've shown. So Jeb, in addition to the jobs data next week, we get inflation data showing the expectation for PCE at 0.19 and 0.24. And then if we look forward to September, they're expecting 0.13 and 0.23. So seeing it continuing to go down and moderate. So not going to get a big, great reaction this month, but at 2.33 and 2.77 on the core. It's still trending in the right direction, but we have some low base year effects from last year. This I thought was important, Jeb. Christopher Waller, one of the Fed governors, was out last week talking. He said, we are completely data dependent at this point. So after a 50 basis point cut, we're looking for future data. So it tells you why the market is trading sideways, because the Fed and the markets are going, what comes next? And we haven't got any fresh data. So their belief inflation is potentially on a lower path than we were expecting. We see a lot of room to move down in the next 6 to 12 months. And we estimate that August PCE will be very low. We get that data tomorrow. It hasn't been a market mover. It's the Fed's preferred measure, but it hasn't moved the market recently. What does it mean in terms of actual interest rates? You see here over the day, up 0.01, over the week, up 0.04, 0.06, 0.02. Most importantly, still down massively over the month and massively over a year. So from that perspective, because lenders are holding rates tighter while the 10-year is inching up, really haven't changed anything we're quoting. People that I quoted on Friday or Monday, they're like, oh, okay, how much worse is my rate? I'm looking at it going, it's really not worse. We can hold the rate where it was. Maybe we make a couple bucks less, but it's been holding pretty solidly.
No, good stuff. So, the title of this video is Here's Why Interest Rates Increased After the Fed Cut. And I think Josh explained it really clearly. The last 3 times that the Fed has done a 50 basis point cut, we've actually seen that reaction happen for the next couple of weeks after, after that initial pop. And so we're kind of trending in the same direction at the moment. The question is, when do we peak, at whatever that new peak is, which is typically lower than the previous peak, and come down from there. So, my guess is probably, October, November data, somewhere in that ballpark. You need slowing. You need more of a slowing economy for them to react a little bit more aggressively. And at the moment, you didn't throw that in there, but the Fed is at the moment, it's looking a higher probability for another 50 basis point cut in November versus a 25 basis point. I think it's like 70-30, somewhere in that ballpark. So higher probability of a 50 basis point again come November, and then an additional one in December, which would be 125 basis points total this year. So we'll keep our eye on that. We'll keep updating you. But for now, put your questions in the chat so that we can start answering them. We've got Knoxville, Tennessee, Olympia, Washington, San Francisco, Cincinnati, Savannah, Springfield, not Missouri, Josh, Virginia. They don't eat dogs there or pets.
Well, let's Springfield, Ohio, where they eat the cats.
Oh, it's Ohio, not Missouri. You're right.
Yeah. I think every state has a Springfield.
I don't know. Does California have a Springfield? It's like The Simpsons. But anyway,
look it up.
Do us a favor, start putting your questions in there. Otherwise, Josh and I are just going to chat.
Otherwise, we're going home. We're going to Wing Wednesday.
We're just going to keep talking like we always do and go from there. So Praxia, which was our Olympia, Washington, I believe, says, "Hi guys, I purchased single family homes a couple times in past years, yet I'd like to know how the financing process for purchasing land might differ. Are there any notable differences? Thank you." Yes, quite a bit different. At least here locally, most land purchases that I'm aware of are cash purchases. Now, I know you can get loans on them. So Josh, that's where you're going to come in.
I wouldn't want a loan on it, unless you could rent it to someone to put a camper on or park some boats on. It's not really going to generate much income, and you're going to have a payment with it. So you can get loans, but you're generally not a high loan to value. You're putting 50% down, 40% down, if not more. Terms are going to be higher. Lenders don't like to lend on them because they don't want to take back dirt, because then they have to sell it. So from that perspective, it's not as liquid, harder to sell, harder to finance, and you're going to put a big down payment, and you're going to have a pile of dirt that doesn't bring you any revenue or put shelter over your head in the meantime.
Awesome. David came in and told us that Sacramento is the Springfield of California. So,
I like it.
Too funny. Good stuff. Outside of that, guys, we don't have any questions, Josh. So let's do this. Let's talk about this past week on the podcast. We talked about the 50 basis point cut. We talked about how that's impacted the market. We talked about what's likely to come. So if you haven't checked out that episode, do us a favor, listen to it. Got a lot of positive feedback from those that have listened to it. So check it out. And this coming week, we actually talk about refinancing in more detail. We actually look at a couple of different loan estimates from clients that have sent them in, people like you from the show, and go over a couple of different things. We talk about essentially what not to do when refinancing, because some of these are clear indicators or clear examples of things to avoid. And, really trying to help you guys make the right decision when it comes to that. And if we can be of assistance during that process, there's actually a link here scrolling in the bottom, where if you need to refinance, you need to talk to Josh, you're in the process, want a second opinion, do us a favor and check out that link there. But Josh, we have a question finally from Laker J. Says, I have a question about a mortgage. Got a 5-1 ARM at 6.49 back in February. Looking for a refinance, hopefully next year if rates hit low 5%. Had a bad experience with my original lender. So he doesn't. Did he have a follow-up there? Yes. He says, you think I have a chance of refinancing without paying any points? I do. You could definitely refinance into a 30-year right now from that 5-1. Is it worth it? I say no. You still got 3 years on that loan. I think it's probably okay to hang on to that loan and wait for lower rates, assuming you're okay with the payment for now, because, going from 649, depending on your loan amount, that's going to be the key there is
That's
if
the
you got
wild card, right? If
yeah,
it's
if
a
you have
$200,000 loan, write it out. If it's a $600,000 loan, you probably could justify it.
yeah, and get yourself into a fixed loan. I mean, it little to no cost on it, but I do think there's an opportunity to do exactly what you're trying to do. It's just a matter of time, right? And the question is, can you do it now with no cost and start reaping the rewards of those savings or not? Use that referral link, talk to Josh, and he can definitely guide you through the process.
Laker J wants us to prognosticate. He's got a question for you, Jeb.
All right,
What
let's
are
hear it.
the odds of rates hitting the high fours?
Odds? I don't know an odd, but I think 100% are the odds. Over what period of time is the questionable part. I think rates will definitely be in the fours in the next couple of years. Is that 2025? Possibly. I think that's realistic. 2026, definitely realistic. Again, a lot of it has to do with the economy. If inflation comes back and you start having issues, then it's going to be a longer time before you hit it. But if inflation continues to stay soft, the economy continues to get weak, rates are the key to helping stimulate the economy. And I think that there's an opportunity for rates to be down there.
So Jeb, here's my take on it. I love to tell people, because a lot of people hear that and they go, "Oh, no way, we're never going to see rates that again. That's crazy." We showed the chart earlier, and if history is a guide, history going back 44 years, 8 Fed cutting cycles, you see a 150 basis point drop in the 10-year from the first cut. That takes you to a 2.2 treasury. We look today without any narrowing of margins. Margins are at 237 today. That puts you at 437.
4.57% rate.
Yeah, four and a half. 4.57
Yeah.
has put you at the rate. So that we could not have spreads narrow at all, and maybe only get 100 basis points from the first cut to the bottom, and it gets you to 4.99. So is it possible? It's not only possible, it's probable. It's not guaranteed, so we don't know. We'll see how it plays out. And as Jeb said, what happens? The economy, inflation, the jobs market.
Good stuff. SNN Media has a question, says, is it possible to withdraw from a 401k as a hardship withdrawal to purchase a home? Will there be a penalty for it if it's used for her first-time home buyer purchase? So I don't even know that you have to do the hardship withdrawal. Now, I know that each company that manages 401ks has a different policy on how they do some of this stuff, but you can take a loan out against your 401k without it being a hardship. Now, you're limited in the amount that you can withdraw, but typically you can withdraw that amount with absolutely no penalties because essentially you're paying that money back to yourself and use it for a first-time home purchase. So Josh, when it comes to the hardship part, maybe you can elaborate a little bit more there because that's not something I've heard of.
So as a first-time buyer, 50% of the balance up to $50,000. So if you have
Okay.
$100,000 in there, if you have $500,000 in there, you can't take out $250,000 and put a big down payment. You can only get $50,000. That is absolutely far and away the best way, one of the best ways to actually save, because if you're saving and investing, it should be growing a little bit faster. You're saving pre-tax, and then it's growing. So you can get to $50,000 almost faster than any other way that you could save. Now, in terms of a hardship withdrawal, please, 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 please do not do this. I will let this person remain nameless. Someone that I know is needing a large sum to buy a partner out of a piece of real estate, and they have $900,000 in their 401k. And they called up and they said, yeah, you can do a hardship. What do you want? So I'm just going to take the 450 out of there. So in that instance, $450,000, there's a 10% penalty because that person's not 59 and a half. So your 450 becomes, 405. Now you've got 405, but that whole 450 is going to get taxed at the end of the year as ordinary income. So if you make $70,000 a year and are used to a really tiny little tax bill, well, for that year, you made $500,000. You get a monstrous tax bill. So it's probably an extreme example. Most people don't have that amount in their 401k, but you really, 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 really want to avoid the hardship withdrawals, borrow, like Jeb said.
All right, good stuff. We have Ife. Ife. I was thinking wife, get rid of the W. Ife. That's
going with Ife, and I think I'm
I think
80%
that's right.
correct.
But I don't see a little hyphen thing, like the little.
Maybe they don't have it on the keyboard.
Nope. Hey, listen, if that's your name, you better get one, like right above the thing. If I'm adding someone in order to have a better debt to income ratio, does the person's credit matter? Or what's the benefit of doing that? And how does it work? So Josh, can you add a co-borrower, and how does their credit impact the main borrower?
Virtually every loan program is going to take the median credit score for all borrowers, 2, 3, 5, however many borrowers you have, median credit score, mid of the three, and the lowest of all of those is how that loan is going to get priced. So from that perspective, lowest common denominator, whoever has the worst credit. Had a listener right here 20 minutes before the show. We're going through it. She's looking to refi, got a real high interest rate, and she has an 800 credit score. And I'm plugging in the numbers. And then she mentions that her partner has a 680 credit score, and the terms got much, much worse in that situation. So fortunately for her, it looks like we'll be able to eliminate him from the transaction, keep him on title, and qualify with just her income and her credit. So from that perspective, you got to balance it. If the only way you qualify is with the additional income from the co-borrower, then we really don't have a choice, right? We have to add them in there. If you qualify without them, they can be on title, they can be an owner with you, but you want to keep them off of the loan because that will drag you down to their level. And Jeb, the one exception in that is some lenders in the non-QM space, in the HELOC space, they will take the mid score of the primary wage earner, but it's pretty rare.
All right, good stuff. I didn't know that. David asked, with most COVID era foreclosures largely out of the system, what are mortgage delinquencies looking like right now? So mortgage delinquencies, last time I looked, were actually ticking down, going the other direction. We get this mortgage monitor monthly, Josh, from Black Knight, I believe. And to be completely honest, I don't follow it as closely because it's more or less irrelevant for the most part. It's not a hot topic. It's not something to really pay attention to, but it's more or less non-existent. There are delinquencies out there. Most of the people that the delinquencies that we're dealing with now are still people that were delinquent prior to the pandemic. A lot of these, it's crazy that
But
some of this stuff takes
Jeb,
years to work through the
Preventer
system.
Consulting told me that by the end of 2022,
Ooh,
there was going to be a massive wave of foreclosures, and I was going to get properties, depending on which video and where we were talking, somewhere between 40 and 60% off of their 2022
how many did you
prices. So
buy?
I didn't get any. Hasn't happened yet. You're telling me the data is not seeing this monstrous spike that it was obviously coming.
But you said 2022, so I assumed that you had bought those 2 years ago.
Well, it just didn't happen though. And it didn't happen in
Uh,
23 or 2024, but the headlines, the video titles are
he's
still the
probably
same.
just ahead of his time. That's it.
Probably
He's just ahead. He's
at this
looking like
time.
50 years out. He's trying to get you ready. If you start saving now, Josh, in 50 years, you're going to be ready for that foreclosure crisis.
Yeah.
SNN Media, another question says, if a builder is eating up the cost of a new build, $700,000 sell price, and the offer rates at 4.99, sales agents say they are eating the cost. Is that a good deal? So I'm assuming the better way to ask this question is buying a $700,000 home. They're giving you a rate of 4.99%. Essentially, there's a buy down associated with that because 4.99% rates don't exist today. So there's some sort of credit going on. The lender's eating that cost. Is that a good deal, Josh?
So we've talked about this a lot. Builders historically have 20 to 25% margins. So on that $700,000 house, 140 to $200,000 of profit in that thing. During COVID, it went even higher. For like 2 years, they were at like 30, 32, 33% profits. And they are really good at knowing their bottom line and managing their margins. So if you're saying to get that 4.99, it probably doesn't even cost them on that $700,000 loan, 15, 18, $20,000, call it $20,000. That's 3% of the purchase price. If they're at 25% margins, it takes them down to 22%. It's a reasonable business decision for them. For them, it's speed and turning their money as often as possible. So a rational business decision for them. And I can tell you, I talk to tons of people who are working. If you go into a big national builder and they tell you that they want you or they're requiring you to approve with their lender and they're offering you a large incentive to use them, take them at their word. It's always smoke and mirrors. They're trying to tell you it's like twice the incentive that it is. But regardless, if they tell you it's a $20,000 credit and it amounts to a $12,000 credit, it's still more than 12,000. Still more than any credit that I'm giving you, that any other lender is giving you, because we have our margins set. It's not, we don't have these massive home builder margins in it. So the builder, through their joint venture or their ownership of that lender, is just taking some of their profits and subsidizing the mortgage for you.
All right. Anu says, when you did those 2 refinancing with lender credits this year, talking to me, did you do those with the same lender or did you have a new lender each time? No, I did them with the same lender. That's how I was able to do what I did. And that's why essentially pricing was aggressive on this, because the lender's looking to keep these loans on the books. So, and there were some incentives in there as well. So no, I did them with the same lender. In fact, all 3 times. So in November, in January, and about a month ago. Closed on the second one, or the third one rather. SNN Media, another question says, Kamala. I watch this guy on TikTok, dude. He's hilarious. And I now can't pronounce her name because the way he says it like gets stuck in my head. But anyway, talks about tackling price gouging as part of her policy. If she wins, how will that impact the housing market? So, can the president impact housing, I guess, is a better question. Better question is, what can the president, whoever the president is, do to impact housing?
What of the last 4 or 5 presidents, going back to Obama, if not George W. Bush before that, most of the things they do, because they can't get anything past the House or the Senate, because we have, for the most part, for the last 20 years, had divided parties between those. What they've been doing is these executive orders, which is silly because then the next president comes in from another party and they reverse all the executive orders that the last one did. You need to actually do this through law. Very unlikely that the spending ideas that either one of these parties are going to come through. But this specific policy question, the price gouging, the one that's insane is that their favorite target is grocery stores. The grocery stores have been price gouging people. There are companies out there that I might be willing to listen to a price gouging argument, but it's one of the lowest margin businesses out there. the government getting involved in fixing prices for anything is never going to be the solution. It will drive the prices for everything, including housing, up. So from that perspective, we'll have to have a political podcast to go through that, Jeb. But you want the Democrats to put that one away as soon as possible.
No, it's a lot like here in California, we raise the minimum wage to whatever it is now, and guess what you see? You see the price of food is just crazy at fast food restaurants. It's nuts. I mean, I don't eat McDonald's, but somebody told me the other day like a Big Mac or something is like $18. I'm like, you got to be kidding me! Like, there's no way that's $18. And look, it's like $18. I'm like, fuck! I remember when that thing was like $4. Anyway. That might date me, when you say stuff like that, but it's just, it's crazy. Let's see. Mina, you've been missing. Mina, I feel like today should have been $20 because the last couple of weeks you haven't been here, and to keep consistent, I don't know. No, in all reality, thank you for the super chat. Says closing on Friday. Thank you guys for educating me and making me less fearful on the home buying process. You are very, very welcome. I appreciate you being here week after week, asking good questions, and ultimately getting to the finish line. That's awesome. Congrats.
She got a new profile picture to go with her new house too. I almost didn't recognize her.
Oh, look at that. Yeah, baby.
We used to have a close-up picture.
Here's the thing. If we have helped you buying a house in any way, send us a picture and like a note, because I want to make an intro video to the podcast every week that plays as we come on. That's the people that's been helped from the show. And I know there's a lot of you out there that listen that have purchased homes. There's a lot of you that listen that are in escrow. If we've helped you directly, Josh just did your loan in any way, I referred you to an agent, let us know on that. That also is very, very helpful. But if you listen to the show, got education, and thought we were part of that process and getting you to the finish line, let us know. We want to make you part of this. And I think it would be really cool to have a full minute, 2 minutes of people that we've actually helped. So you can reach us directly. Our contact information is out there where you can get that to us if we've been of any assistance to you. Josh, did you hit and flag anything for me? But let's see what we got.
David just had another comment that California had an insurance commissioner regulate and dictate what insurance rates could be. And look how well it's worked out for us.
Yes. Yeah. My insurance guy, I think I've talked about this before. Essentially what they did was they put a ban on these companies being able to increase rates for like 5 years. And so once that 5-year time period was up, whatever the period was, I don't know the exact time frame, but I think it was 5, then they could increase it to a certain percentage. And what happened was all these insurance companies increased it to the max possible because they had been losing money for the better part of 5 years because they couldn't increase at all because of some of the regulation here in California. And I know a lot of people out there are like, well, these insurance companies, you just make so much money. In some markets they do, other markets they get hammered. We talked about before, looking at, the earnings of some of these companies. Some of them are barely staying above water because they're having to pay out because of natural disasters and all those crazy things. So, not fighting for insurance companies here. I hate them as much as anyone else. But like anything, when you get government involved in telling what can be charged and what can't be charged, and then open it up, it gets pushed to the max. All right.
Josh has an interesting question. If you have a joint bank account with your spouse and they're not on the loan application, could you count their income since it's on your bank statement? No, absolutely not. We're not looking at your bank statement for income. That is what your W-2s and pay stubs and tax returns and things of that sort are for. The bank account is solely for determining, do you have sourced and seasoned funds for the purchase? So it will add an extra requirement there. If you have a joint bank account, the joint account holder has to sign a letter that states that you have full and unfettered access to the funds in that account, but it won't help you in terms of using their income.
Good. Let's see, Josh. We have run through the questions here. Tonight's an easy night.
We got lots of viewers, but no questions. You guys, have we educated you? Are you completely educated? So no one has any more questions?
Anoop says, isn't it fair?
Jeb, hold on. I wanted to point this out to you.
Yeah.
This is the same Anu. He's watching. He's 2 of our viewers right now. Anu P. Thomas then pops up as a new PT. So I appreciate that he's pumping up our views
Oh,
by
he's watching from two things.
watching under two separate profiles. I appreciate
The haters will say that we're doing it. They'll say that we've got
we're
multiple
paying anew.
people.
We're paying anew in burgers to keep up with the
Yes,
price of
this is like
housing
a
and watch
this
us.
is like a rally. We are paying people to be here to hear us talk. Isn't it fair the price of burgers keeps up with the price of housing? I think absolutely. Yes, it should go up the same amount as housing. Let's see. Josh, we have nothing else. So Josh,
We got
let's
nothing.
talk about something else. What do we got? You got something?
Fantasy football, that'll excite everyone. Everyone loves to hear that.
No, we definitely don't want to hear about fantasy football.
Arturo Taveras closed today. Thanks so much for clearing our minds of so much question.
Good stuff.
Awesome. Congratulations, Arturo. Where Mina, I think you are in California. Mina, Arturo, where did you guys end up buying? You don't need to give us your address.
Huntington Beach,
city and state.
No, let us know. Yeah, it's good to get a grasp of where people are. Dina's always in here. Dina's owned a home for better part of a year, maybe over now, and shows up every week. Yonkers, New York. We couldn't help in Yonkers anyway. I could have referred you to somebody, but an agent, but no loans up there.
I just like saying Yonkers.
You're Yonkers, dude. Rimstar says, if you have a conventional loan and plan to refinance, should you stay with conventional or change the loan type? Josh, what is your go-to there?
Really, you would only change if there's some sort of a benefit. You probably got the conventional loan because that was the optimal solution for you. So what benefit does FHA have over conventional? Lower down payment, but you have an upfront mortgage insurance premium and monthly mortgage insurance for the life of the loan. So you wouldn't switch from conventional to FHA. VA, you have to be VA eligible. USDA, you need to be meet income limits, and the property needs to be USDA eligible. So for the most part, people are going to go conventional to conventional. What I will say, there would be an example, someone going conventional to FHA for a cash out refi. If they have a lower credit score, cash out refis to high loan to value with a lower credit score can be really expensive. That's really the most common situation for switching loan programs from conventional to something else.
All right. But in reality, you could do that. But what's more common is going from something like an FHA to a conventional.
Yep.
VA, you would typically stay with VA, that sort of thing. So rarely ever are you going from one to another unless you're trying to get rid of mortgage insurance or do something else. Josh, we got True from San Diego, and Codis has a VA loan at 5.28. So you're not going anywhere at the moment. That's it. We've accomplished everything we came here to do this evening. If you have questions, guys,
done.
we got about 15 minutes here. Happy to address some questions. Ask us anything. Doesn't have to be housing related. Let's get off topic. Let's go down a rabbit's hole. Let's talk about anything you guys want to talk about.
Jeb, one of the things that we didn't have in the slides leading off the show tonight, we got mortgage application data today. Refis continue a big trend up. I think if I was reading the chart correctly, I didn't look too deeply at it. The month over month, week over week is up massively, but the year over year, we're kind of back to where we were a year or so ago, which was kind of surprising to me. But refis up big, purchases finally starting to tick up. And the big question that I get, I'm sure you get this one also, Jeb, with rates down, affordability improving, applications up, does that mean that home prices are going to skyrocket from here? With this dip in rates, with the Fed meeting 2 weeks ago, you seeing any additional buyer activity?
I don't. I mean, buyer activities, no, not really. I mean, honestly, the market seems to have slowed down a little bit, to be completely honest. Seeing homes sit a little bit longer. The homes I will say, the homes that are still nicely remodeled in good locations, under 1.5 million, and they're priced right, are still selling pretty quickly. The ones that aren't are the ones that have done shoddy work on remodels. And just, either overpriced or bad inferior location, that sort of thing. Those homes where, 6 months ago, they still would have sold, 2 years ago would have been gone first day. That stuff is still sitting longer. I got a report today from, Orange County Housing Report, one of the reports that we get. I can't publish it, but I did talk about it on Instagram. And one of the interesting things in that report, so it's looking at data from August, so it's a couple weeks old at this point. But what they showed is the number of homes that were selling at the list price, above the list price, below the list price. So there was about 70% of the homes were selling below the asking price. Pretty good amount. And then they go in and say how many of the homes had a price reduction and or a price increase from their original price of those properties that closed in August. And about 50% of those homes had the original purchase price from where they listed it, but 70% of the homes that sold in that month sold below that asking price. So just because the seller's not reducing the price doesn't mean that they're not willing to accept the lower offer, is what I got from that. Now, it could have been some of the homes that were reduced were the ones that sold. You don't know exactly the correlation there, but the reality is half the homes didn't have a movement in price, but yet 70% of the homes sold under where they below some sort of asking price. And so take that when you're out there as a buyer, home's been listed 2 weeks, it's okay. If it's not getting activity, doesn't mean you can get a massive discount on it, but one thing it's telling you is you probably don't have to go above the asking price. You can get a little bit more aggressive on the price. The last couple of offers that we've made, we've been under the asking price on all of them. In fact, the last two, the buyers are paying my compensation directly. They're not building it into the purchase price to help their offer be a little bit more aggressive to get a lower baseline, if you will, when it comes to that price, because taxes are based off that. A lot of things are based off that purchase price, which in theory is going to cost more money over the long run. So both these buyers are choosing to pay me directly through the close of escrow, and so it helps them stand out in that scenario.
All right, Jeb, you asked.
Yep.
We got a bunch of questions now.
Let's hear it. Are you going to put one up there?
Yeah, let's go with this one. Can you explain capital gains tax? I paid 178, sold for 380. Will I owe any capital gains?
So capital gains, the way the capital gains works, you need to talk to a CPA, but the way that the law or the rule works, the tax code works, is that as a single individual, you get $250,000 in tax-free gain of that property, right? So if you bought it for 178, you in theory could sell it for 430. What was the purchase? I forget the numbers now. I can't read it there on the screen.
178. So 428 you could sell it for.
Yeah, you could sell it for. Yeah, exactly. You could just go ahead and finish. You can just
no, you can sell it for 428, but you also there's some things you can reduce from that. Yep. Your costs on the way in, your costs on the way out. Yep. So you probably sell it for 450. Just remember the most important thing, it's got to be your primary residence. You have to live there a total of 2 out of the last 5 years. So yep. Sounds like that's the case. It was your residence. As long as you were there for 2 years with that amount of gains, even a single person, you're going to be totally tax-free on that one.
And the one thing we didn't mention there is that if you're married, you have a partner, you get up to $500,000 in tax-free gains. So it means you could sell it for, $678 at that point and still have and avoid taxes. Now, 2 of the last 5 is the key, but you can only do it every 2 years. So if you've lived in 2 primary homes, 2 of the last 5, it's possible for that to happen. You can't sell them both consecutively, one behind another and get that tax-free gain. There has to be a 2-year break in between those properties in order to get it, but doesn't sound like that's the case. You should be good. Clyde says, can you refinance if you bought your rate down? So Josh, is there any limitations to refinancing?
No restrictions. So you just have some sunk costs there. You paid money that you probably didn't have the time to recoup the benefit of. So it would have been better to do the 0-point loan instead of buying that rate down. But it doesn't prevent you from doing the loan. I've had the question, Jeb, someone says, well, paid $10,000 to buy my rate down. It only brought my payment down $200. So I need 50 months to break even. Should I wait till I break even to refinance? Absolutely not. It's a sunk cost. Whether you refinance now or not is irrelevant to whether you gain that back. You shouldn't volunteer to pay more for the next 30, 35 months so that you recoup that money before you start saving money. Do whatever is best today.
All right. Smart Fox says, is it true repeal Prop 13 is in the ballot this year in San Diego? If so, what's the chance this will happen? So I don't know that it's on the ballot again this year. I haven't seen anything about Prop 13 being back on the ballot this year. It wouldn't be just San Diego. It would be a California thing. So it would be statewide. I haven't seen it. It has showed up several times over the course of my tenure here in California, which is 20 years. And every single time it's been shot down. You know, what happens when you have a majority, a super majority running a state is if they don't see what they want, they continue to put things on a ballot and just hope at some point somebody gets it. And they change the language and change things in order to make it happen. And it's crazy that that can happen. But the reality is it will probably pop up again. If it's not on it this year, which I don't think it is, it probably will pop up at some point again in the future. So, you know, yeah. Anyway, I could go down. I could talk about that a lot. But
Jeb,
yep.
You've been holding out, but I want you to tell us. Oscar would like you to know what the mortgage rates will look like in December.
You know, they're going to be under 6%. That's where they're going to be, under 6.
So he also followed up here and said, it looks like the rates did not change in Miami. Rates absolutely changed in Miami. They have changed everywhere. So I'm not sure who you're talking to. If you're maybe dealing with the builders, lenders, I'm expecting to be closing on a new home by December or January. I don't know if that means new build or an existing home that's new to you. If you are talking with a lender and they have indicated that rates have not dropped over the last 60 to 90 days, I would suggest talking to a new lender. We actually have a referral link down there where we get you connected with one so you could run through some numbers, Oscar, because that's not right. Rates in Miami
or Josh,
no
you actually do loans in Florida. You talk to Josh. So, you know, whether you're buying a home, refinancing, need a second opinion, use that referral link. Josh is helping a lot of people from the show, a lot of people from my channel just overall and the podcast get to the finish line. So if you need help, want a second quote, just making sure you're getting a good deal, use that link there. I you know, nothing lost in having a conversation. Josh, there was another one here that Rimstar said, you said the mortgage insurance will be on for the life of the loan, or is it possible to come off? So FHA loans, mortgage insurance is on it for the life of the loan when you put less than 10% down. So most people, when they do FHA, they do the 3.5% down option, maybe 5%, but most people aren't doing 10% doing FHA, which means regardless of your equity in that property, you're going to have mortgage insurance on that loan until you refinance, till you pay it off, till you do whatever. It's one of the downsides. Now, if you put more than 10% down doing an FHA loan, it will fall off after the 11th year. That's the only time it comes off. More than 10% down payment after you pay for 11 years. If you get a conventional loan, falls off when you get, 22% equity in that property. You have a 78% loan to value. You can have an FHA loan and have 20% equity and refinance into a conventional loan. That's another way to do it. But just some things to keep in mind. Now, if you have an FHA loan and it's from 2020, 2021, listen, the fact that you're paying mortgage insurance, you shouldn't even care. You should be elated that you're paying mortgage insurance, even if it's 0.85%, because chances are you got a rate in the high 2s, low 3s. And, if you got a 3% FHA rate from 2021 and your mortgage insurance is 0.85, you got a 3.85% effective interest rate. That's better than any rate out there in the market by a long shot. Yeah, it sucks.
But I can tell you from experience, Jeb, those people are obsessed.
I know. They want to get rid of it.
Low mortgage.
Do not. Just hang tight. You're good. Just keep doing what you're doing. You're lucky. Yeah, I said you're lucky. Don't Sell says, I have a deferment for $15K on one of my investment homes. My lender said to pay off my deferment loan before I get a second. Is that true? My lender said maybe I have to pay off my deferment loan until I get a second or before I get a second, Josh. Is that true?
So if there's a deferred balance, the only way for that to happen is the lender agreed to take less than what they were contractually, you were obligated to pay. So at some point you didn't meet the terms of the agreement. So it does tell any lender coming after them, hey, there's an issue here. Now on a new first mortgage, we can generally pay that off if it's a seasoned deferred balance. But remember, second mortgages, these don't go to Fannie Mae. They don't go to Freddie Mac. Freddie Mac was going to do a pilot with second mortgages, but these are generally smaller lenders and they make their own guidelines. And they're looking at this saying, we don't like it. My question would be, can you use a portion of the proceeds of the second to pay off that deferred balance? Most likely you'll be able to, but obviously it would take that $15,000, which a lot of those deferred balances that I see, they're not interest accruing. doing. So take it from no interest to interest. But if it's the only way to get your second, it may be the thing that you have to do. But the important thing to note is there's not a blanket guideline on this. We can't tell you. It's that lender's guideline. You might talk to 5 different lenders and get 5 different answers.
All right, good stuff. Sanjay says, are realtors and clients hacking Zillow or Redfin algorithms to make it higher in some pockets? Any idea? I've never heard of this. I think the answer is no. I don't know a way to hack the algorithm. They just basically, the problem with the Zillow or Redfin or whatever is when they pull comps, they're pulling general areas. They're not basing location. Rarely are they, taking a view versus a non-view versus a house that's remodeled versus not, because they don't know based on this information. So they're just using, a basic algorithm to produce values. Now, one thing you can do in Zillow and Redfin to change values of homes is when you list it, a lot of times once you list a home, the algorithm will change to effectively go closer to where you're listing that home. But here's the thing, you shouldn't be paying attention to Zillow or Redfin anyway when they say a home is worth something. It means nothing. So if you're buying a home and the price is $1 million and Zillow says it's worth 1.2, are you going to be like, well, Zillow says it's worth 1.2, I'm getting a deal, or it's worth 900, oh, it's overpriced? No. Use comps. Have your agent provide comparable sales from that neighborhood and show you what's actually sold, what's comparable to that property. That's what you should be using. Don't use sites like that. They're great for what they are. They're great for searching for property, but they are not great for telling you whether or not a property is priced correctly. So it's as simple as I can put it. Rely on your agent. That's one thing you're paying your agent to do is
get a
do
good
that for
one.
you. Get a good one. We got somebody watching from Thailand.
Oh, we're
Look at
worldwide.
that.
Mr. Worldwide, right?
We
here.
are. You're like Pitbull, dude.
Yeah.
Let's see here. Claudia has a 5.8. Does my chance of refinancing possible next year? Hard to say, Claudia, but I would think by next year you'd have an opportunity to refinance. Gravity Zero says, I was told if you sell your house after the 2nd year or before the 5th year, you can avoid tax on the profit gain. But what if I refinance in a house I lived in for 10 years? Does it reset? And the answer is no, it does not reset.
There's no reset. And you say before the end of the 5th year, that doesn't have anything to do. It's a rolling 5-year period.
Yep.
So that 5-year period is from today back 5 years. Did you live there 2 out of the most recent 5 years?
Jennifer Lego. For those of you who don't know Jennifer was our moderator here for a good time, and then she just disappeared. Doesn't care about us anymore. She bought a house and moved on.
She was educated and moved on. Educated and owns.
She is educated. But she's got a 3.625%, and she got 16% equity in her property. Why? Because she actually bought a house. So congrats to you on both the equity and the interest rate. Both are things that a lot of people wish they had. Drew says he's looking to buy a house near New York City. Can I expect rates to go lower, and will that affect already high prices of homes? So can't say, specifically about New York City, but what I know about the Northeast at the moment is that inventory is still a problem. Buyer demand is still there. So if that's the case for the area that you're looking, lower rates is probably going to bring more buyer demand, which in turn is probably, if nothing else, stabilizes home prices even further and probably pushes them up. So I would think yes, to answer the question. But if the market is, flooded with inventory, nobody's buying it, then no, it's not going to be that problem. But I think the Northeast is still an outlier when looking at nationwide with regard to inventory and price appreciation. Josh, just all the questions just came out of the woodwork.
They waited. They're waiting us out to see if we would stay till after 6.
Here's one, Josh. You can do this one quickly. What is a VA interest rate reduction loan?
It's a streamlined refinance, does not require income documentation, does not require an appraisal. So it keeps costs down, keeps the timeline down, makes it much easier for you. Really just need mortgage statement, homeowner's insurance, an HOA statement if there is one, and a loan application. So very, very easy, very, very fast, lower cost than other types of loan. There are a couple of things that have to apply for you to be eligible. You have to have made 7 on-time payments on the current mortgage. So if you bought 3 months ago, talk to a listener this morning, they've only been in there, they've made 4 payments. So we got 3 more to go before we can do that loan. So 7 on-time payments, and you have to be dropping your rate at least 0.5%. And the costs of the loan, you have to recoup them within 36 months. So if you have $300 monthly savings over 36 months, it's over $10,000. The costs of the loan, not your prepaids, taxes, insurance, prepaid interest, but your actual hard costs of the loan, you have to recoup those in 3 years. And most of the veterans that we're doing those EARLs for right now are recouping them in 4 months, 6 months, 8 months, way less than a year.
All right, good stuff. Again, we said this earlier in the show. If you need help with refinancing, you need a second quote. A lot of people are sending us loan estimates. People are texting them to me, sending them through Instagram to me. But the best way to do it is use that referral link on the bottom of the screen. It'll get you in touch with us. We can have that conversation, or the team can have that conversation and see whether or not it makes sense. About half the people, it's making sense. Other half, it doesn't make sense right now for one reason or another. We actually talk about that in next week's podcast, which is going on Tuesday. Things you should avoid in refinancing. So with that, Josh, how often can someone refinance?
There's nothing that prevents you from refinancing every time there's a net tangible benefit. Nearly every loan program, FHA, VA, USDA, conventional, you can't churn that loan. So even if you were dumb and you found a lender that was taking advantage of you, if there's not a net tangible benefit that can be documented on paper, you're not going to be able to do that. But as long as there's a benefit, there's nothing preventing you from doing it as often as you want. We've talked about this on the show. If you pay off that loan in less than 180 days, your lender is going to be subject to an early payoff penalty, unless rare exceptions like Jeb's lender is a portfolio lender. They don't have that policy. They let their loan officers do those loans again in less than 6 months. So for the most part, you need to stay in that loan for 6 months. Most people don't want to do them more often than that. There's some paperwork, some effort, some energy involved. So we do want to be strategic about how often we're doing it, even if we're able to do it at zero net cost like Jeb's refi.
All right, good stuff, guys. So if we can be of assistance to you in any way, you need a realtor referral, use that referral link. You want to talk with Josh, get in touch with Josh. Next Wednesday, I'm gone traveling to North Carolina to visit family. Josh will be here doing the podcast. So make sure you stay tuned. But until then, adios, amigos.